Canada adjusted its bond buying program once again today, and they have adjusted their inflation targets. Obviously, no big increases to rates, but I want to talk about inflation. I want to talk about what the Bank of Canada is doing, and I want to talk about how that affects you. And at the end of this video, I'm actually going to break down the inflation risks, both positive and negative, and how that could affect your home borrowing, home buying decisions, and so on and so forth. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video, and don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 to put towards their RSP, their RESP, their TFSA, to pay down their debt, to pay down their mortgage, or simply to do with whatever they like. But in order to win, you have to subscribe, so go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Let's get into it. Let's discuss inflation, the Bank of Canada, what they're doing, the moves they're making, and when you can expect interest rates to start going up. And the interest rates starting to go up question is going to be the one that is going to be really hard to answer, because we are seeing a significant difference in the conversation and the policy work that the Bank of Canada is doing versus the work that the Federal Reserve Bank in the US is doing, and the predictions. Right now, as of today, the Bank of Canada is expected to increase interest rates late in 2022, and then potentially have a up to 1% increase, so 4 increases over the next year following that. And in contrast, the Federal Reserve Bank is saying that they are going to maybe increase interest rates starting in 2023, and at most they're going to see 2 interest rate increases over the year following that. So what becomes the question is, who is right, which one is more reliable, and ultimately what would happen if the Bank of Canada actually made the moves that they say they're going to make if the US didn't make the moves in line with what Canada did? And the answer to that is really quite simple. For the Bank of Canada right now to increase interest rates ahead of the Federal Reserve Bank in the US, it would mean an appreciating Canadian dollar, which means our goods would become more expensive, and therefore it would have an impact on the economy. Canada, of course, being a net exporting country. So the interesting thing here is, why is the conversation different in the US than it is in Canada? And I do believe that the reason that the conversation is different is because we've got this huge run up in borrowing and housing prices. And the Bank of Canada, quite simply, has to be at the forefront of having those conversations about increasing interest rates early in order to stem the sort of ongoing buying and ongoing borrowing that's happening. So I don't know exactly what's going to happen, but at the end of this video, I'm going to show you the risks that the Bank of Canada has identified to inflation and subsequently to higher interest rates. And we're going to talk a little bit about what that actually means as far as increasing interest rates. So I'm going to pop you into the computer screen as we do here, and I'm going to show you the headline from BNN Bloomberg: Bank of Canada boosts inflation forecast, dials back bond buying. So first thing you need to know about what happened today is the Bank of Canada is reducing their bond buying program from $3 billion per week to $2 billion per week. You can expect that they're going to reduce this again to $1 billion per week later this year. And what those moves are is essentially the equivalent of an interest rate increase. Now, it doesn't increase the interest rate or the prime rate, but it is essentially the same as taking 0.25% of stimulus out of the economy. Because what happened was, when interest rates got really low, the Bank of Canada had to start finding other ways to inject money into the economy, which was the bond buying program, which basically facilitated all of the government spending that the Liberals in Ottawa have been spending as of late. And what the Bank of Canada is now saying is that we want to reduce the bond buying program. We don't want to hold as much of the Canadian government bonds as we do, and they're gradually reducing that. Once they reduce that, then they will start thinking about and considering increasing interest rates. But that's going to take some time, at least until the end of 2022. Now, lots of interesting stuff in this article. Highly recommend you go and take a look at it. Whether or not they make moves ahead of the Fed, from an economic standpoint, I don't see them making big moves ahead of the Fed. I don't see them stepping out of line and increasing interest rates faster. Jerome Powell has gone on the record and said we are a long way away from having the sustained level of economic activity in the US that we need in order to increase interest rates. Now, keep in mind that the US fully opened far sooner than we did. So they are way ahead of the game from a activity standpoint than Canada is. However, Canada is saying that we're going to increase interest rates earlier and we're going to increase them more. It doesn't make a ton of sense. So again, I think when you look at it from an economics perspective, sometimes the narrative is just as powerful as the actual actions. And I think that's what's happening here is you see the Bank of Canada saying we're going to increase interest rates sooner and faster, primarily just to dissuade some borrowing, which, by the way, you know, I make my living off of borrowing. I make my living off of selling debt. I am not opposed to them having conversations about higher interest rates, increasing interest rates in order to slow down the craziness of the Toronto and the Vancouver market. And we've seen that this is happening. We've seen in the Toronto market, if you look at the video yesterday, that it is helping to slow down the market. And that is a very, very, very good thing. Just continuing through and taking a look, I want to pull up the actual monetary policy report. I'm going to start on page 26 of this report. You can by all means go and read this, take a look at the graphs. It's really interesting if you're into that sort of thing. If not, you can pretty much watch this video and get most of the information. But I wanted to point out two things. The first is this graph, which is the CPI forecast, so the inflation forecast. And then I wanted to go through and I wanted to point out the risk to inflation. So this is the inflation forecast graph. And what you can see is that, and by the way, CPI is the black line. You can see that they're targeting and their forecasting is showing that right around now, we're getting to the highest levels of what they expect inflation to look like. And then you can see as we hit mid 2022 here, we're starting to expect that inflation is going to come back down to 2% and then slowly grow from there. So that's kind of when things are expected to get back to normal. And the Bank of Canada today talked about the fact that there are major issues in the supply chain. There are major issues, obviously, with the price of gasoline right now and shipping gasoline and all of those things. And that is leading to increases in inflation that are artificial and somewhat over and above what the pandemic effect would be. And they expect that the supply issues at some point will subside. The base effects of last year and basically the deflation that happened last year will eventually go away. And that's why they're expecting things to somewhat return back to normal in that late 2022 stage. Now, here's what's interesting to me. If you take a look at this inflation forecast, they're saying they're expecting inflation to come back to normal around late 2022. I have to think that if inflation ends up at 2% or less than 2% at the end of 2022, as this forecast is suggesting, I have to think that the likelihood of actually seeing a rate increase is very, very low. So their forecast, what they're saying is one thing, which is we're going to increase interest rates at the end of 2022, but their inflation forecast, this is their own inflation forecast, is telling a significantly different story. And if inflation's running at 2% and it's running pretty much between 2 and 3% running into 2023 and the end of 2023, I don't think those 4.25% interest rate increases are something that are necessarily going to be on the table, because what you have to remember is that that quarter interest rate increase is going to have a pretty significant impact on the economy. And it'll actually make it harder once they increase it once to increase it again and again and again. Now, that gets me into the conversation around the risk factors. I'm going to scroll down to this. It's at the very end of the monetary policy report for July. And I want to show you basically the 5 or 6 things that they've outlined as risk to inflation. So these are the things that could either increase inflation faster or decrease inflation. So another wave of infections. This would obviously decrease inflation. It would decrease economic activity. What's interesting is if you go to the graph at the very, very beginning of this report, it shows the coronavirus infection levels in different countries. What's interesting is that the United Kingdom has a very similar level of vaccinations to Canada right now, but they're seeing an increase in cases, which is somewhat disturbing. I don't think that we can completely rule out another lockdown, another set of restrictions, another series of infections coming into the fall and winter. And if that happens, then we could see lower economic activity and therefore potentially lower economic growth and lower inflation. Next thing is stronger household spending in Canada. So let's say all the money that Canadians have been saving starts to actually go into the economy. We're seeing a little bit of that now. Typically in the past, 1920s during the Spanish flu pandemic, after the wars, people tend to slowly reintroduce money back into the economy. They don't go spending full tilt right out of the gate. Usually takes 2 or 3 years. But if that happens faster, you could see inflation rise quicker, which could lead to faster rising interest rates. More persistent supply bottlenecks and cost pressures. So if there are lockdowns, if there is the inability to get supply to markets, if there's the inability to transport supply, if there is, for whatever reason, less chips available for cars. These are the sorts of things that basically shift the supply curve. And when you shift the supply curve, lower the amount of supply, what that causes is increased prices. Increased prices is, by definition, inflation. So if there's more bottlenecks, that could be something that increases costs. We're hoping that the supply chain normalizes here fairly soon. Might take a year, 2 years for it to get back to normal, but we do see that it is normalizing in some way, shape, or form. Weaker exports. Now, this is a big one. If the Bank of Canada moves too fast, if the value of the Canadian dollar goes up too much, you can pretty much rest assured that we're going to have weaker exports, which means that we are probably going to have lower inflation. And that is going to be a big one because obviously less money coming into the economy from other countries means that we're going to have lower economic growth, which means lower inflation. So that, I think, is going to be the big one. And if they increase interest rates before other countries, this is going to be the one to watch, is how much does it impact exports? A more pronounced slowing of the Canadian housing market. Let's certainly hope that this is something that is going to slow down. And I say that as a member of the real estate and mortgage industry, but I do hope that this is going to slow down and the craziness is going to subside, at least in some way, shape, or form. But if it does and it subsides substantially and overshoots, so the market crashes, that would have a negative effect on inflation, a negative effect on growth. And guess what? It would lead probably to lower interest rates, which means housing prices would probably come back up fairly quickly. Sharp tightening of global financial conditions. This is obviously a big one. If there is a sharp tightening in global financial conditions. So in other words, if other countries aren't able to spend, if other countries aren't able to purchase our exports, that could have a big effect on our economy and could sustain the length of time that we are in a really, really low interest rate environments. Now, here's the thing. All of these things, none of them are going to act independently. A little bit of each of these things is probably going to happen, and therefore the combined picture is what we're going to end up looking at 2 years, 3 years down the road. So here's the thing. We got this prediction, interest rates will increase end of 2022. I think you can rest assured that that's your worst case scenario. High likelihood that interest rates remain lower for longer. And at the end of the day, nobody can really forecast this. But what I suggest, and if you're in the market to get a mortgage, what I suggest is taking advantage of the low rates until such time as they look like they're going to go up. So we've been selling the variable rate strategy for quite some time. It is really simple. We take a variable rate at 1.5%. Or lower, and we hold on to that as long as we can until it looks like interest rates start to go up. If interest rates do start to go up in 2022, it means that we get a year at basically 0.5% off. So if you have a $500,000 mortgage, you lock in $2,500 worth of savings. You then have at least 2 interest rate increases before you are back to break even on the interest rate, and then 2 more until you're actually going to lose any sort of money. It would take at least 4 interest rate increases for you to be in a situation where you have given that $2,500 back to the bank. But if we can lock you in prior to that increase in interest rates, then what we're doing is we're extending your low rate runway for at least a 6 to 7 to 8 year period. So that's the strategy. We firmly believe that variable is the way to go until interest rates do start to look like they're going to rise. And if they start to rise far later than expected, then we're certainly going to save a significant amount of money. If it takes 2 or 3 years, we could save $5,000 to $7,500 over 2 or 3 years just by having the right strategy. And of course, as those interest rates start to go up, we can start locking in interest rates and basically get the best of both worlds from a variable and a fixed rate strategy. Now, if you're in the market for a mortgage, if you are thinking about getting a mortgage, obviously, we would love to have you apply with Mortgage 360, and we're happy to help anybody who would like to go down that road. But we understand that sometimes people have their own bank or their own broker that they want to deal with, and that's fine. But what I want to do, because my why is to inspire people to thrive and to give back. So therefore, I want to make sure that everybody's equipped with the same sort of information that a Mortgage 360 client would get. So what we have done is we've put together a course called Secrets to Getting the Lowest Interest Rate. It teaches you how to negotiate with your bank, how to negotiate with your broker, how to negotiate specific things into your mortgage that you may not realize you can negotiate in, and where to find the lowest interest rates and the surprises and the landmines that come along with it. Course takes less than 60 minutes to complete. It is priced so economical that anybody who takes it will, and I guarantee this, get at least 10 to 50 times their money back just by taking this course. In fact, I've put an offer from Mortgage 360 in that course to guarantee that you will get at least 10 times your money back should you decide to get a mortgage with Mortgage 360. It is super cost effective, super easy, super affordable for anybody who is looking at buying a house or getting a mortgage. And I've put a link in the description below with a coupon code, which I'm probably going to remove in the next couple days here, for 50% off the already discounted price on that course. I would sincerely hope that you join us, or allow us to join you on your rate searching journey, and ultimately allow us to teach you and educate you on the things that you may not otherwise know. But this will give you the tools that you need to be on a level playing field with that banker, with that broker, and with those people who are selling you that mortgage. And of course, like I said, I'd prefer you do it through us, but if you don't, that's my offer to you. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We are clearing 15,000 subscribers today. By the way, we hit 1 million views as of today. So if you haven't subscribed already, click that subscribe button and we'll see you on the next video. Cheers.